The Redbox stock has been the topic of many conversations as of late, and in today's video, we're going to look at its price actions, the recent developments, the technicals, and my opinion on if you should be buying the stock. As the market is still very volatile at the moment, we would be mindful about which positions to assume, as well as their individual timing and exposure. Before the video begins, if you would like to see more stock analysis videos like this one, please remember to like, comment, and subscribe to my channel. Redbox has seen a full week of red so far, and the stock price has also decreased by at least 30% from the peak. This kind of retracement has now surpassed my initial projections, and I believe that although it's not necessarily caused by additional short selling pressure, it's at least caused by the decreased interest from the retail traders in order to keep buying the stock to make sure that the stock price remains high. I mean, we have to remember that the stock requires massive injection of new demand in order to lift up the current price, and without it, the downward spiral will simply turn into a self-fulfilling prophecy, because the fundamentals of this company has never been the reason why people may buy it, and the major spikes that we saw the weeks before may tempt some traders to liquidate their positions in order to realize some gains, or to get back from their feet. Let's keep in mind that the top of the stock over the past 12 months has gone above $20 before almost touching the penny stock level. Going forward, I think that although the current price action is not very encouraging, we must not lose the sight that as long as the stock is having a massive short interest, it'll have a mechanically important volume of shares that will have to be bought back. The real question now is how low will it go before this redemption happens, and the outcome will largely depend on the retail participation in the days to come. Now, let's also take a look at the technicals of the stock. The trading volume of Redbox has recently been 5.2 million shares versus an average of volume of 21 million shares. Over the previous 52-week period, the price fluctuated between $1.61 and $27.22. The trading volume is a metric that can tell you how many shares are being exchanging hands and whether there's a lot of momentum and activities for the stock. It often gives you a first idea about the popularity of the company, and when we use it to compare it against the average volume, it can also tell us if the company is enjoying additional momentum to reverse its trend or to break through current resistance levels. Even when the current volume is lower than the average, it is an interesting indication because it may signify that a trend reversal may happen soon. The market cap of Redbox is currently at $334 million versus an enterprise value of $297 million. Simply put, the market cap is the fair market value the company has based on its current market sentiment, the company's reputation, and other macroeconomic factors, whereas the enterprise value is usually the cost the company has already paid for its assets after paying off the debts. It's worth mentioning that one of the most significant assets for a lot of growth companies may be the intangibles, meaning they're not items or equipment for the company, but rather their intellectual properties, brands, and patents, which are essentially the tokens that guarantees to the stock market that the company will grow significantly in the future. For many startups, most of their valuations are based on the valuation of the intangibles, meaning they can be valued in very favorable market conditions if they went public over the past 2 years. In concrete terms, this means that there can be a huge difference between the market cap and the enterprise value, giving a false impression to the market participants that a company is trading at a discount. It's only trading below its book value, but this doesn't mean that a company itself is necessarily undervalued. It's also possible that a company itself was overvalued in the first place and that only now has deflated back to where it's supposed to be. As we compare the current price to the historical price fluctuations, the stock is 35% higher than the 1-month low, 270% higher than the 3-month low, and 325% higher than the 52-week low. On the options market, which often gives a hint on the market sentiment about where the stock price is likely going to go next, the implied volatility is 220% compared to a historical volatility of 263%. The put-call volume ratio is currently at 3.28, meaning it's very high, We should also remember that for most stocks, there tends to be a higher put option volume than what they deserve as institutional investors hedge their long positions. The most recent volume of options traded is 35,000 contracts a day versus the 30-day average of 71,000. In terms of open interest, the most recent volume of open interest has been 180,000 contracts versus the 30-day average of 223,000 contracts. The option contract is a derivative from the underlying security, giving participants the possibility to have a right to either buy or sell the security at a predetermined strike price. Buying the contract gives you the right, and selling the contract gives you the premiums, with an obligation to execute the contract if the counterparty chooses to do so. It is often said that you can evaluate the likelihood of a scenario based on the opposite of what's going to happen. Maybe in this case, it applies a little bit less because I also think that a retracement is bound to continue, but if there's a lot of put options, then there may be possible uptrends on the move, or that a reversal can happen if there's a lot of call options. The reasoning behind that theory is quite simple, as most options tend to expire worthless. In terms of its shareholder structure, institutional shareholders own about 154% of the outstanding shares. The biggest shareholders include Apollo Management Holdings, Vanguard, and Millennium Management. It is relevant to understand the shareholder composition of a company because it helps to determine whether you should hold the stock long-term or to view it as a trade opportunity. If the stock is mainly held by retail traders, this can be a sign that the stock lacks the depth to justify long-term trust from shareholders. Typically, the consensus is that there should be at least 25 to 30% of institutional participation for the stock to be perceived as a sound investment. Again, it may not apply for Redbox. This is obviously subject to a lot of exceptions, such as in this case, since many titles are also held by retail investors and they're good companies, but that tends to be the exception and not the rule. Another possible scenario is that a lot of the ownership is actually borrowed shares from brokers in order to short the stock, which is the opposite of what we're looking for. Let's also take a look at the short interest present in the stock, which is the amount of positions aiming to profit if the share price falls lower. At times, there may be significant short interest in the total volume, which can be a sign that there is an organized shorting operation happening, like what's going on with GameStop and AMC. The current short interest is 154% of the total float, and 47% of the transactions are coming out of the dark pools. Usually, if the short interest is above 15% of the total volume and a significant chunk of it coming out outside of the public exchanges, it may suggest that there are institutional positions taken to short the stock, which is obviously the case with Redbox at the moment. My recommendation, therefore, is to buy a position in Redbox and to keep it for at least a few months, and also have a relatively large allocation set aside in case it goes further down. We have to remember that this is a stock that is made for trading, not necessarily to hold for long term. I would thus therefore recommend to commit between 1 to 3% of your portfolio's capital in Redbox, and also recommend to split the allocation in batches of 10 to 20% at a time, so that you may purchase more in case it retraces. Now, given the current market environment, I believe that the equity market is in a vast phase of correction, especially when it comes to tech and growth type equities. The financial market has been living and breathing thanks to the continuous creation of new capital, with different waves of quantitative easings, which will have consequences on the price of assets as well as their yields. With the interest rates kept relatively low over the years and the increase of amount of capital in circulation, this will keep putting significant pressure on the profit that we can expect in investment products across the board. And this, by the way, is a reality that may shift in the years to come if the interest rate of core infrastructures within our globally financialized system increases. It's useful to remember that the market doesn't represent the real economy, and of course, the real economy doesn't always reflect in the stock performance, since the name of the game here is ultimately called supply and demand, which depends on a whole bunch of factors that go way beyond our own control. If we think about it, this is like saying, if your neighborhood house that is put up for sale is only allowing those who actually want to live inside to buy it, versus if you allow every single type of buyer with different intent or reasons to buy or to sell it. So obviously, there will be a significant difference in the price of this asset for those two scenarios. The market currently works more like the second option, and assuming that it would only reflect the fundamentals of the underlying economy would correspond to the first option. There are a few elements that are considered to be the reasons. The first one is the significant increase of amount of money printed by the central banks around the world, which is then distributed to the banks, with the expectation that they will be loaned to businesses. Normally that's a good thing, but with a lack of opportunities in the real economy, the significant portion of that money actually went back to the financial system to buy up the price of existing assets. Now that the QEs have been wrapping up or ended around the world, I think that this drive behind asset price may no longer be as relevant as it is right now for the future. It is now compensated by the arrival of capital from one region to another, and from one sector to another even within the same jurisdiction. With the increase of tensions around the world, capital is always looking for a safe haven to park their money into, not just for a place to grow the nominal value, but with a currency that tends to keep its purchasing power as well. The third factor is the creation or the birth of artificial bubbles, either maintained by the market trends built up over the years or out of necessity. Capital needs to find a place to stay. Some good examples of this would include the EV sector in the 2020 and the oil and gas securities when there are tensions around the world. Either way, when it comes to the price trends of the market, the degree of uncertainty is a key drive behind the price fluctuations, and that is likely going to increase as we go on from there. When companies announce that they are going to enter or exit different markets, or that they will be trading on different platforms and exchanges, this can all have significant ramifications on the price of this asset. Some of the considerations to have when operating in this context include having a clear view of what is going on, especially regarding the cash flow and the capital flow, and avoid certain potential pitfalls. One of these is to be careful with short positions. Inherently, short positions are riskier than long positions, as the downside of long positions is limited, whereas the short positions can lose you as much money as the stock price may reach, which is infinite. On top of that, we're now seeing a new phenomenon with short squeezes, involving a group of retail traders propping the stock price up, forcing short sellers to recover their positions. Sometimes the attempt will not succeed, but sometimes they end up in very spectacular success. Something else to consider is to treat tech stocks with care. To start, ask questions when the price of a security skyrockets without real fundamentals. It doesn't mean that you shouldn't be touching it with a 10-foot pole, but it does mean that there should be a difference between the decision of long-term holding and short-term trading. Either way, a rule of thumb is that each position should be structured in a way so that their individual performances will never affect the portfolio's stability. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.